our next speaker is Ed Mendlowitz CPA, someone that I've been a fan of for a number of years. And this is the first opportunity we've had to have him come in and speak. So, Ed, I'm going to give it to you.
Okay, thank you very much. Hi, everybody. Today we're going to talk about something that we're going to begin by talking about something you don't want to talk about. We're going to talk about you dying. You're all going to die. You may not know when, but you will. And that's really what we want to talk about. When people plan their affairs, they usually start out, they have a will. If they have partners, they have a buy-sell agreement with their partners, which I consider a buy-sell agreement, a will for a business. And if you're a one-person owner, you should have a practice continuation agreement, which most people don't have. And that's what we're going to talk about, a practice continuation agreement for a one-owner business. Now, this could also apply if you have two partners, if there's two owners, because if you travel together, like I did with one of my partners, a plane could go down. So you should have these things in place. So they're very important. But I'll tell you something else. These are things that you could offer to consult with your clients to have them set up. Now, if your client's a manufacturer or a completely different kind of business, I have a plan set up for accountants, for an accounting practice, but you could adapt this to almost any kind of business for your clients. Your clients have that you have a single owner businesses, and if they die prematurely or die without arrangements or they come disabled, who takes over running their business? Who's going to sign the payroll check? Who's going to make sure that the work gets completed? So this would be good for consulting with your clients also. Now, what happened was the way this started was really very simple. I was having breakfast one morning in my house with my wife, and it was a Friday morning, and my partner and I, Peter and I, were going to travel on Sunday to a conference. I think we were going to Palm Springs at the time to go to a conference, not so bad. My wife says to me over breakfast, you and Peter are going on a plane. What happens if the plane goes down? What do I do? So I, being a typical husband, said, "What are you talking about? Don't bother me. Ain't going to happen." And that was the end of the conversation. And then when I got to the office, I said, "Peter, Ronnie said that want to know what would happen if the plane goes down. We don't have a plan. We don't know what she should do." So we talked about it. And then what we did is we said we should make a plan to someone to take over our practice. We had no employees that we could do it with at that time. But if we did, then we might have prepared a plan for the employees. But when you do it with employees, that sort of changes the dynamics with the employee, because you're telling an employee who probably likes his job, maybe he doesn't want to be an entrepreneur, that you might be in a position someday of taking this over. And then if the owner decides to sell the practice someday, and you're leaving the employee out of the mix, so to speak, they might feel that they've been betrayed. So doing it with an employee is not good, but that's not what Peter and I thought about. We thought about that we had nobody. So what Peter did is, what Peter and I each did, we made a list of a few firms that we would call to see if they want to take over our practice. And it's funny because he put down 3 names, I put down 3 names, and none of the names were the same. And we talked about all 6 names, and we eliminated all 6 of them for one reason or another. And then we started thinking about it, and we came up with a guy who we felt had the right size practice, who could take over our practice. So I called him up. His name was Danny. I said, "Danny, Peter and I are going on a trip. If the plane goes down, would you be willing to take over our practice?" He said, "Sure." "How would we do it?" I said, "I don't know. Let me work something out." He says, "Okay, you work it out. Send it to me. If it's okay, I'll sign it and we'll have an agreement." So I sat down, I wrote up something, wrote up a plan, went over it with Peter. He edited it, we changed it, we adjusted it, we signed it, we faxed it to Danny, and then 10 minutes later, he signed it and he faxed it back to us. We had an agreement. And then I spent the rest of the day preparing lists and things that might be needed if we went down. And I put it in a sealed envelope. Peter had a copy, I had a copy. And I went home that night. I said, Ronnie, I have an agreement. If the plane goes down, this is who you call. If the plane goes down, you open up this envelope. Even before you call the rabbi, you open up this envelope, call the guy in here, and all the information he's going to need is in here. And Peter did the same thing with his wife. Thank God we never used it. The envelope, well, it's been shredded a long time ago because we didn't need it. And that's what we did. That agreement that I made up that day is basically the agreement that I have in this toolkit that I have, that you're going to get a copy of the toolkit. It's about a 35 page booklet that has all the forms, all the letters, all the instructions, everything you should need to know. And basically, it's something that I set up, that I was willing to have my practice sold to protect my family and to protect some of the wealth from the practice. I was willing to accept this kind of deal, and the person who signed it was willing to assume the obligation and take over the practice. So it was a real deal. The next thing that happened over the years is, because I like to write and I like to give speeches and I know a lot of people, and what I did is I wrote it up and I started giving it away for nothing. And in the course of the next few years, I would say about a dozen friends called me and signed the agreements with me and Peter that if anything happened to them, we would take over their practice. And again, we developed a whole process, a whole procedure, which I'm going to go over with you now. So this is real stuff. I do want to tell you that if you die suddenly, there's going to be confusion. There's going to be a lot of unknowns, a lot of nervousness, a lot of consternation. And one thing that and also trying to sell the practice is going to be very difficult. It's going to take time. And the longer it takes to sell your practice, the less you're going to get, or the less that will be gotten by your family, and the less clients that you're going to end up keeping. So that's what we're going to talk about. Now, I got to do this quick. Now, let me ask you a question, and this is the same question that would come up if you're the one who died, or if you were buying a practice from someone, from an estate of someone who died. Who's going to sell the practice? Is it going to be the spouse? Will it be your partner? The partner, if you're not married to someone, would it be that person? Would it be your executor, or would it be a child? And if it's a child, which child would it be? This is not an easy thing. Who is authorized to act on your behalf? The executor wouldn't even be qualified yet. The spouse probably would be the most logical person, assuming that your assets would be left to the spouse, but it may not be. But also, she won't be legally qualified to sign a contract unless she's the executor. And if it's a child, suppose you have 4 kids, which one of the 4 kids would be doing it? And if they're typical kids like they are in most families, they also don't get they don't get together as well as they should, as well as you would like them to get. Now, let me tell you what happens. And if you ever try to buy a practice of someone who died, you know this. Usually, someone dies and there's an asset like the practice. Nothing really happens by the spouse. What happens is the spouse is approached, and the spouse asks the lawyer what to do. Well, no lawyer is going to say to do something without having a valuation. So the first thing the lawyer is probably going to say is, well, I don't know what it's worth. What we need to do is get someone to value the practice. Or maybe we could find 3 people who want to buy it, and then we'll take the highest offer. When you're not trying to sell a practice, it's very easy to find a buyer. They're all over the woodwork. But if you want to sell a practice, very hard to find a buyer. So the next thing is the attorney, you or the attorney or the family has to find the buyer. Then you have to negotiate a price. But not only do you negotiate a price, you got to negotiate payment terms. Everybody wants more money than it's worth, and everybody wants money up front. And if you buy a practice, you really don't want to pay a lot of money up front. If you get an SBA loan, on that basis, you could pay the money up front. But that process could take a few months anyway, and you don't have that luxury with when someone dies. So you got to negotiate a price and payment terms. You got to identify what's being sold. Is it the client list? Is it the office? Is it the equipment? Is it you have employees working for you? You may have asset management that you do. You may have ongoing bookkeeping work. You could have a lot of small accounting firms have with tax practices do a lot of bookkeeping. The bookkeeping that they do for clients could generate much more revenue than the tax returns they do. Every widow, always feels they're getting ripped off. So automatically, when the state tries to sell something, no matter what the price is, the widow is going to feel she's getting ripped off and will not be appreciative that somebody is bailing the family out and helping them out when the person who died really screwed them by not having arrangements. You got to also try to keep clients, staff, and the practice intact. I've know of people who died, and while the widow was futzing around with a lawyer, a key staff person stole the clients. So now try suing the key staff person when there's no agreements or anything. You want to keep the practice as intact as possible. You got to get the information together. When we do things ourselves on a daily basis, we like to think we're organized. Yeah, the client's file to do their tax return might be organized, but our practice itself is not organized the way it should be. So we got to get all that stuff together, and we got to notify clients. So what happened? So these are problems. These are real problems that come up. I've seen them happen all the time. If there's a temporary disability, death is easy because death, you're dead, and the practice is gone, and whatever the price is, it is, and the family gets whatever they get, and that's the end of it. But if you're temporarily disabled, you want to go back to work. You want someone to be a caretaker to take care of your practice while you're at a commission. So you got to have somebody who's willing to do the work. If you die in July, it would be a lot easier than if you died on February 14th, in which case everybody that would help you is going to be overloaded with work. If you die in July, people will figure out a way of making do, and you don't have the crush of the emergency, of the time crush that you have. How does payment get made? The person's going to do the work. What do they charge? What do they keep? Do they get a percentage of the fees? Do they get their normal hourly rate? Do they get the normal hourly rate at a discount? This stuff has to be worked out. The disability might be temporary, but could continue longer than you expect, or it could become permanent. So what do you do at that point? The person who's stepping in, maybe you're disabled for 9 months. You expected to be disabled for 3 months, but you got an infection in the hospital, and you're going to take 6 weeks to convalesce with that, and then you got to get some physical therapy because you lied on your bed too much. Could be 8 or 9 months. Maybe the person who stepped in to help you out wants to take some of the clients, which could be a natural thing. Now, the worst thing that you could have is getting involved in a fight with this other accountant over the client. In that case, you're both going to not get the client. you're going to lose it, and the new guy's not going to get it. So what kind of payment arrangement is it that guy wants to take some clients? The arrangement, the letter I have takes this into account. Nothing's perfect, nothing's great, but we try to do the best we could, and we work it out with money. We try to work it out with a fairness of money at a time when neither person thinks anything bad's going to happen. You're preparing for something bad, but you're not, you're not in the mindset that something terrible. And what's the taxability of the payments to the family? Is that going to be non-employee compensation? Is it going to be capital gain? How do you work it out? All these things have to be discussed and have to be worked out and have to be ironed out, so to speak. Now, the importance, by the way, the kit that I'm going to give you that you're going to be sent afterwards has all the sample arrangements. Every question that I'm mentioning or talking about will be answered in that kit. Now, who do you do the practice continuation agreement with? Basically, you need someone that could absorb the work. If you're a sole practitioner with one person working for you, you don't want to make the deal with another sole practitioner with one person because they can't absorb all that extra work. You might need, I would say you need a practice that's 3 or 4 times bigger than you. If you're 3 or 4 times bigger, that would be the right size to be able to absorb your practice, and your practice and the revenue from it would become meaningful to them. And they'll work out a way of getting the work done. A practice 20 times bigger probably wouldn't be suitable because your clients wouldn't be meaningful to them. Your book of business would not be meaningful. Yeah, if you had 1 or 2 gigantic sized clients, maybe that would be meaningful, but not the base of your practice. So you got to identify who it could be, and they got to have a compatibility with you. The elements of the plan. My plan is very simple. And remember, we're making a drop-dead plan, which we hope never gets implemented. And I thank God that my plan was not implemented, and none of the plans where I said I would buy a practice was ever implemented. So thank God for that. Now, the person buying the practice. Now, I called Danny, called him on a Friday morning, wanted him to sign an agreement Friday afternoon. So I said, fine, I don't want any down payment. I'm going to give you no retention guarantee. You're going to work on the clients for 5 years. I get 20% of what you collect. If you keep a client, I get 20%. If you raise the fees for that client, I get 20%. If the client grows, I get 20%. If the client is lost for any reason, I don't get anything. So there's no guarantee by him. The guarantee is he's going to take care of my clients. He's going to work on them. He's going to do his best that he could, and he's going to try to retain them. That's a guarantee that he's given me. But I'm not giving him. But I'm not asking him to be out of pocket anything. He may not want to be out of pocket. He's not looking to buy a practice. He's looking to help me out. God forbid I drop dead prematurely or got killed. So I get paid 20% of collections for 5 years. I want to tell you that I bought a few practices where I paid 20% of collections for 5 years. One practice I bought, I gave 0 down payment. I got no retention guarantee. And I told the guy he'll get 20% of collections for 5 years. The payments that he got over that 5-year period was equal to 140% of the revenue that he grossed the year before he sold me the practice. So it was a great deal for him. It was a great deal for me. We kept all the business clients. In fact, one of those, this happened in 1993, I think in the end of 1993 or January 1994. And today we have one client where the fee is probably 3 or 4 times greater than the entire value of the practice that we bought at that time. Now, you need a trade-off. So the trade-off is that the guy that's buying the practice is not going to get a tax deduction. He's going to amortize it over 15 years, and I get the capital gain. If you're asking someone to take over your practice, you want to make it no money down, no guarantee, no. He pays 20% of collection. He collects money, he pays it. Doesn't collect, doesn't pay it. But I want something in exchange, and what I want in exchange is a 197 asset. If I'm dead, it'll be tax free, and you don't have to impute interest on a 197 asset. If I'm alive and it's a disability, I get his capital gain. He or the buyer gets it amortized over 15 years. And of course, it must be someone you trust. This is very important because you're extending credit. If you have a $100,000 practice, you're extending $100,000 credit to somebody. And in the case of the practice I bought, it was $140,000. He was extending me $140,000 of credit because that's what the practice ended up being worth. By the way, that practice that we bought, we told the guy up front that we wanted the business clients, and we'll do whatever we could to keep the business clients, but we really don't want the tax clients. There may be 5 tax clients we wanted. So he said, fine, do all the returns the first year on the same basis of the fee that I was doing, and then after the first year, you do whatever you want with those clients. Because we bought the practice, I think, on January 1st. And that's what we did. And I think we ended up keeping about 5. It was 5 clients we wanted to keep. We kept those. And the other clients, I think we might have kept a couple for some various reasons. But the rest of them, we sort of let go. It wasn't hard to let them go. We told them, we did the fee. We charged you the same price that George charged you. But next year, our normal fee is, let's say at that time, we charged $200. And we said that a normal fee, a minimum fee is $500. If you want to come back, we'd like to have you back, but that's the minimum fee. So then those people came back, which was okay. If I knew then what I knew now, I would have raised every fee 5%. So the $200 client, I would have charged him $210. Not the end of the world, but I would have made a few extra dollars that I wouldn't have made, and I would have got the extra 5%. So I tell people now, when you buy a practice, at least raise the fee 5%. And again, you got to be someone you trust. Now, what I did with Danny was very simple. We faxed them the agreement, faxed it back, signed. We had an agreement. But the ones that we did with people where we were going to take over their practice, we had like a closing. By the way, just to tell you, which I don't recommend, but I'll tell you what I did. We used my letter, which is in the kit. Now it's in the kit, but I used my letter. We signed, and we didn't have a lawyer look it over. We didn't do anything with a lawyer. We wrote the letter out. They signed it. We signed it. And we had a letter of instructions. And we had the spouse come to the meeting. We signed it at the meeting, and we had a letter of instructions, and we read the letter of instructions to the spouse to tell her she has to call us right away. She was introduced to me and my partners. We told her, the husband said, look, I have a list of everything. I'm not giving anything to Ed, I'm giving it to you. Ed doesn't get anything unless I'm dead. Unless I'm 6 feet under, or will be 6 feet under in a day or two, because you got to call Ed right away. And we made sure the spouse understood that she had to call us right away. I think that we did it with all men. I think there was one woman that we did it with, one woman accountant. Except the woman accountant was totally organized, had her act together, and none of the men had their act together. I've had this experience now with a lot of women accountants. If the women accountants, I'm much more impressed with, to be honest with you, than in terms of their organization, their follow through, their dedication to what they do. I have a small sample, but that's how I feel. Next. What do you prepare? I sort of mentioned this. You prepare a list of all your clients. You put a client grouping. You could have 5 different kinds of clients, but they're all part of the same client group, and they can have all different billing codes and everything. You put a list, you write out what the services are performed and the fee and the payment arrangements. And I got to tell you something. When I did this for Danny, I wrote out some. I wrote it briefly. I wasn't going to make a career out of it, and I was rushing to get it done. This was Friday. We're doing it Friday afternoon. Had some work I had to get out, and I was going away for 4 days. But in doing it, I realized that there's a lot of work that we're doing for clients that went past the original agreement and past the original service arrangement and fee arrangement. So I made a note of these, and then in the next few months after that, I actually contacted the clients, increased the fees to cover the added work, and I got it all from the clients. So I actually made money from this process. The next is you have staff. You got to put down the staff responsibilities and what the strengths and weaknesses are. You could have great staff people but they're not great in everything. So put down what they're great at and give them that work. And the stuff that they're weak in, don't give them that. Give it to the other people. So if you have staff, you could do that. If you're just yourself, you can't. It is what it is. This didn't exist when I made the deal with Danny, but now you have a list of all your passwords. This is very important. People take over your practice. They got to know all the passwords of everything. This is mind-boggling. I personally have my own Excel list of about 250 passwords. Now a lot of them are the same. If I buy from department stores online, I use one password for all the department stores. I'm not worried someone's going to steal that number. I also don't embed my credit card in anything. I don't embed any bank account or brokerage accounts in my computer. Each time I log on, I got to log on separately with the name, the username, and the password. And I log on to clients' accounts. I'm responsible for paying some clients' bills, and everything are okay in the bills. I don't have that embedded in my computer. My computer gets lost or stolen. People could have access to my client's money. Anyway, you need a list of passwords. And you may have some legacy clients, or you might have a family tree where you have some really small clients that you have no right having, except that those people might have referred 3 of your 8 largest clients. They might have referred to you. You're never going to drop those people. So this is how you prepare beforehand. Who do you tell about the agreement? You certainly tell your spouse or the relative that's going to likely handle your final arrangements. But I wouldn't tell anybody else. It's no one's business. However, sometimes you might have a key client, and it might be important for that key client to know that you have support if you get disabled or you get killed, that you have support and you have backup. And you might also want to let the banker for that key client know, because they get nervous sometimes if it's a sole practitioner and they have a big line of credit. They want to know that there'll be some continuity if you get by a bus, the proverbial bus. But I would not tell staff. I would not tell clients. I wouldn't tell anybody else, except if you have 1 or 2 key clients where you think it's important that they should know. When should the successor firm be notified? ASAP, as soon as you die. The first call after you die should be to the successor, because you could live in Midtown Manhattan, have a practice in Midtown Manhattan, but you're part of a small community. If you're in a small town, then everybody knows you anyway. But word gets out right away when someone dies, and everybody has friends. Every one of your clients has friends who are accountants, and those friends know who their accountant is. If they hear someone died, they're going to be calling them to take over the account, even before the body is cold. So call the successor immediately. Tell that to your spouse. After the sale, got to notify staff, clients. You got to transfer phone numbers, email, and websites. Got to transfer files. You got to do a press release, and then you have tail insurance. Tail insurance is the person selling would have malpractice insurance in case a claim comes up, saying 3 years after the sale. Now this is expensive, but you got to have it. It's the bigger the deductible, the less expensive it is. But I would say you got to have something that's manageable with the deductible and manageable. Usually, it's a one-time payment for a 3-year tail. In the kit that you're going to get, Nicole said she will send you the kit. I have all these letters and have all this information, sample press releases, all that stuff. So you don't have to do too much of it and read the kit. Now, this is something that people are concerned about. They're afraid that they're going to turn over information to people and it might hamper them from selling the practice at a later time or from running their practice as is. So this slide gives a listing of the effect of this agreement if you're in good health. Nothing, nada, niente, nothing. This has no effect on anything. It doesn't stop you from doing anything. It doesn't stop you from negotiating to sell your practice. It doesn't stop you from acquiring another practice. It doesn't stop you for anything, and you could change it anytime you want. So this part of it is really doesn't hamper you or tie you down for anything. Now, I want to just tell you a couple of stories of things that I've seen. Somebody dies, an accountant dies, and the wife goes to the attorney, and the attorney says, "Okay, I'll help you sell it." And there's a local accountant who was very good friends with the accountant who died, and he says, "I'll take over the practice. I'll pay you one times. I'll pay over 5 years, one time when I collect." Something similar to my deal. He doesn't know what my deal is, but he says, "I'll pay you. I can't give you any money down. I'll give you 20% down, and then I'll pay you what I collect for 5 years." The attorney, this has happened. The attorney says, "Nope, we're talking to other people who will pay 2 times gross. Will pay. Let's say it's a $100,000 practice. They said they'll pay $200,000 practice. Your price is too low." Now that attorney is lying. First of all, he doesn't know what he's doing. Second of all, no one's going to pay 2 times gross for the practice. So he got an attorney that the widow is depending on, and he's lying. He doesn't know what he's doing, and he's lying, and they're not good lies. And this just delays things. It causes, it gets everybody upset, and it doesn't work out. So that's something that can happen. Another thing that can happen is you might have a long-term employee who doesn't want to buy the practice, doesn't want to take it over, never thought he would take it over, but he's worried about his job, and he starts seeing a few clients leave, and he gets nervous that if enough clients leave, and he has no boss anyway, he's sort of running it, which he doesn't mind on a temporary basis. But when he sees the clients starting to leave, he just says, "This is not for me," and he quits and gets another job somewhere else. Now the practice is going to pot because nobody is maintaining any kind of continuity. The other thing is when people want to take over a practice, I've seen this where they might try to lowball it. So they might say, "Well, I'll pay you half. The practice grossed $100,000 last year. I'll pay you $50,000. So the widow says, "No, it's too little. Is not the going rate?" So the guy says, "Okay," and he raises the offer to whatever he raises the offer to. Once that's done, it shows that there was a lack of good faith with his first offer. It shows that his first offer was not a good one or a lowball one, and it creates a distrust now. and that deal either is not going to get done, or it'll get done where you will have lost half the practice already, and the widow is thinking she's getting completely ripped off by the guy, but she has no choice. So instead of someone feeling good that they sold the business and they got a good price for the business, they got a fair price, they're feeling anger at the person. So you don't want that either. If I'm buying something, if I'm helping somebody out, or if I'm buying something, in my mind, I'm doing a good deed. I want them to be appreciative of what I'm doing. I don't want them to feel I'm ripping them off. So that doesn't work. The other thing is, every estate wants to settle quickly, and settle quickly, I'll define it within 6 months to a year. So they don't want notes stretched out more than a year. They want the money up front, or they want the money paid in full within a year. Unless you're going to borrow the money from a bank, you can't pay the money up, or unless you have the money already. But a lot of people don't have the extra money sitting in their account to buy out a practice. If you're buying a practice, the practice should be paid for out of the proceeds out of the profits from the practice. So you pay 20% a year for 5 years. So whatever revenue you have, $100,000 practice, you're receiving $100,000. You give 20% of it. That leaves you with $80,000. You cover your expenses and everything, and then you make a salary for running it. So you're not getting rich on it, but you're not getting poor. You're not reaching into your pocket. You're making a few bucks on it. At the end of 5 years, you own the practice outright. The estate wants the money up front, which is a natural thing, and it's a normal thing. If you have the agreement, the continuation agreement, you basically have the terms spelled out. In my standard agreement, it's the terms of 5 years. So the estate, it doesn't have to be kept open. It could distribute the note. So you're not keeping the estate open, but you're delaying the payments to the heirs. Now, whatever the buyer, and by the way, the buyers that I have come in contact with, quite few, a lot of them feel guilty or they feel an obligation to help out the widow or the family. That's not their obligation. The obligation was of the person who died. It was his obligation to protect his family. And in my opinion, he screwed his family by not having an arrangement. He screwed them. He screwed them, not you. And it's not your job to make it better. What your job is to make a fair deal so you could take over running the practice, maintain as much of the practice as you can, and pay them as much money as you can based on collections. Your energy should be to servicing the clients and growing the practice. By the way, just to tell you, that practice I bought where I paid the guy 20% of collections for 5 years, his billable rate when we took over the practice was $46 an hour at a time that my billable rate was $125 an hour. So you say, well, how could a $125 an hour firm take over $46 an hour practice? Very easily. We saw the work he did. We told the client, look, last year, this is what you paid George, $15,000 last year. We're not going to raise your fee for the first year. We're going to charge you $15,000, but we're going to bill it to you $1,250 a month. We're going to bill you on the first of the month. We expect to get paid when you receive the bill. And at the end of 12 months, we will review the time, we'll review the work we did, we'll review how you feel about us and the value you receive. And at that point, we will discuss a fee going forward. And I got to tell you, not only do we keep every client, but, oh yeah, and we told the client that we will also convert all of your work to the computer at our expense. And if you end up not wanting to keep us at the end of the year, you'll still have everything on your computer. So nobody said no. Everybody agreed to the fee. By the way, by getting paid the beginning of every month, I speeded up my cash flow by a month, because if I did $1,250 of work in January, that bill would have gone out to be in, say, around the 9th or 10th of February. I would have got a check around the 20th, 25th of February. Now I was getting a check on the 10th of January. So I immediately got a flood of cash flow. 1/12 of the year's fees came in cash flow in January, literally before we did any work. So that worked out. Also, by converting things to computer, we eliminated a lot of time that George was putting in. Look, I'm not going to tell you that we made a fortune the first year, because we didn't, but we didn't get killed either. We did pretty good on it. And then, of course, everything was converted, and we had good relations with the clients. We raised the fees every year, reasonable amounts. What I should have done, mistake I made, I should have told everybody, look, last year you paid George $15,000. We're going to raise your fee 10%. We're going to raise it 10% for the year. So it'll be $1,650, but we're going to lock it in as a guaranteed fee. It won't be based on time. Yada, yada, yada. We're going to bill you $112 for that a month. I think I would have got the 10%. Looking back in retrospect, I would have had no trouble getting it. So I cost myself some money. Plus, I cost myself the money for every year going forward after that, because you get raises on top of raises. So that's another little tip or suggestion that you could do. But when you take over practice, you're taking over the billing patterns, the billing methods, the timing of the billing. I was talking to somebody a month ago. He asked me to help him buy a practice, but the guy he's buying it from was 6 months behind in billing. So what's going to happen is the billing would have been caught up eventually at some point, but the guy buying it wouldn't have had any cash flow for 5-6 months, because the clients would be paying for work that was done 5-6 months earlier. So I told him that you could do it, but you can't pay the price. It's not worth the price that you're paying. You got to pay a lower price. You got to offer a lower price, because you're starting out with zero cash flow. So, he offered the lower price, and nothing's been decided yet. But I can tell you right now that if it's not decided by now, it's not going to get done. But these are the things that you got to look at. I got all these stories are in the booklet that you're going to get. Now, you got to get it done. You got to get it done for yourself if you become disabled. Just picture becoming disabled. What's going to happen? By the way, I got to tell you something else. Somebody died, an accountant died, and his brother-in-law called me, asked if I wanted to take over his practice. I said, no, I don't buy practices anymore from estates. I don't want to get involved in it. But I found out later on that this guy cherry-picked and took the good clients, and what he was selling on behalf of his sister-in-law, everything else. All the kind of clients I probably wouldn't have wanted anyway. While they have a dozen really good clients, he kept. So he cherry-picked. So he was trying to screw me. I found that out later on. If you got to do it for your family, if you're going to die, this is important. It's very important. If you didn't get the gist of it, of what I said, then you probably wasted your time on this program. You also got to do it for your staff, clients, and your landlord. You want to have some continuity of the practice. It's good for everybody, and at some level, you owe it to your clients and you owe it to your staff to try to have a smooth transition. But in doing it, you're going to have more money for your family. It'll also make you feel more secure. When I told my wife, when I came home that night from work, that Friday I said, I listened to you. You were right. I told her the story, and I said, I have an agreement. We have an agreement. This is who you call. She felt very good about it. She didn't care what the agreement was. She didn't care anything about it other than I had something, and she had someone to call. God forbid the plane went down with Peter and I on it. And this is something that it'd be very important for you. You could turn this into a service that you could advise your clients to get this done for themselves. Every client you have needs to have some sort of plan. I'm doing a succession plan now for a client, and in doing the succession plan, I'm doing a succession plan. The succession plan is valuing the company, deciding how much to give to two key people. How do you give it to them? How are they taxed on it? There's a lot of facets to it. Can they take over? What can they take over? But I said to my client, well, what happens if you die prematurely? Who's going to sign the payroll check that's due 2 days after you die? I don't know. So we immediately put into a plan. He's putting these key people as signatories on his bank account. This is before we have a plan or anything. They're employees. So at least somebody, and he also put his sister-in-law on the bank account. So the bottom line is your clients need this done for themselves, and they need a plan. And I could tell you, if you want to do this for your clients, you could contact me and I can give you a plan that you could carry this forward to your clients. I've written blogs on it, and if you could go through, I don't know how many thousand blogs I wrote and find this, or you send me an email and I'll send you the information how to do it for your clients. So leverage what you just learned, not only to help yourself and to get it done, but where you can make it into a service. And I think this concludes my talk. And you're welcome to contact me with if you have any information about this program, or if you have any practice management issues, you're certainly welcome to call me. And that concludes my talk, and I'll turn it back.
Hey, Ed, I really, really appreciate that you were able to get together with us